The New Zealand share market is buzzing. Investors and traders alike are feeling a renewed sense of optimism and excitement. The air is thick with anticipation as everyone watches the numbers climb. Why? The Dow Jones Industrial Average and S&P 500 are up. These indices are often seen as barometers of the overall health of the global economy, and their rise is a positive signal. This signals positive movement for our market too. When major indices like these show gains, it often leads to a ripple effect, boosting confidence in other markets around the world. Investors are breathing a sigh of relief. After weeks of uncertainty and volatility, this upward trend is a welcome change. The mood on the trading floor is noticeably lighter. The reason? Potential tariff relief. The ongoing trade tensions have been a significant source of anxiety for investors, and any hint of resolution is met with enthusiasm. The mere whisper of easing trade tensions is like a shot of adrenaline for the markets. It injects a sense of hope and possibility, driving up stock prices and encouraging investment. After 3 sessions of decline, the Dow Jones surged by 0.87%, reaching 42,891.49. This rebound is a strong indicator of market resilience. The S&P 500 wasn't far behind, climbing 0.82% to close at 5,825.68. This broad-based index reflects the performance of 500 of the largest companies listed on stock exchanges in the United States. Even the tech-heavy Nasdaq joined the party, posting a 1.07% gain. This index is often driven by the performance of major technology companies, which have been particularly sensitive to trade news. This isn't just a blip on the radar. The sustained upward movement suggests that investors are feeling more confident about the future. This surge represents a shift in sentiment. The market is moving from a place of fear and caution to one of optimism and opportunity. The possibility of tariff relief is injecting optimism into the market. Investors are hopeful that easing trade tensions will lead to more stable and predictable economic conditions. But is this optimism justified? Let's delve deeper. While the current surge is encouraging, it's important to consider the underlying factors and potential risks that could impact the market in the long term. Let's look at the numbers. The Dow Jones Industrial Average and the S&P 500, two of the most closely watched indices in the world, are experiencing a significant surge. This upward movement is capturing the attention of investors and analysts alike. The Dow and S&P 500, those titans of the financial world, are on an upswing. This isn't just a minor blip, it's a substantial rise that has everyone talking. The trading floors are buzzing with excitement as traders react to the latest developments. This isn't a random occurrence. Analysts are diving deep into the data, trying to understand the underlying factors driving this surge. It's a reaction to tangible news, not just market speculation. This is a reaction to tangible news. Reports suggest the White House might hit pause on auto tariffs, a move that could have significant implications for the economy. Reports suggest the White House might hit pause on auto tariffs. This potential policy shift is being seen as a positive sign by the markets, leading to increased investor confidence. Even better, there are rumors of broader tariff relief. If these rumors turn out to be true, it could mean a significant easing of trade tensions, which have been a major source of market volatility. Imagine a pressure cooker releasing steam. That's the market reacting to the potential easing of trade tensions. Investors are optimistic, hoping that this could lead to a more stable economic environment. That's the market reacting to the potential easing of trade tensions. Investors are optimistic. They see a light at the end of the tariff tunnel. But hold on, they see a light at the end of the tariff tunnel. But hold on, before we get too excited, let's remember something important. The market is a fickle beast. It's influenced by a complex interplay of factors, and what goes up can just as easily come down. The market is a fickle beast. It's influenced by a complex interplay of factors. Tariff relief is just one piece of the puzzle. There are many other elements at play, including economic data, corporate earnings, and global events. It's influenced by a complex interplay of factors. Tariff relief is just one piece of the puzzle. Investors need to stay vigilant and keep an eye on the broader economic picture. Tariff relief is just one piece of the puzzle. As always, it's crucial to consider the bigger picture and not get swept away by short-term market movements. Stay informed, stay cautious, and keep watching the numbers. Let's talk tariffs. Those pesky taxes on imported goods. They've been a thorn in the side of businesses for a while now. The prospect of tariff relief is like a breath of fresh air. Think about it. Lower tariffs mean lower costs for businesses. Those savings can be passed on to consumers. It's a win-win situation. But the real question is, how much of an impact will this have on the bottom line? History tells us that tariff changes can have a ripple effect. Remember what happened when tariffs were imposed? Prices went up, companies struggled. Now, imagine that in reverse. Tariff relief could unleash a wave of economic activity. Amidst the euphoria of a potential tariff truce, a sobering piece of news emerged: the ADP employment report. The report, a key indicator of the labor market's health, delivered a blow. It showed weaker than expected job growth in February. Only 77,000 private jobs were added, a significant drop from January's figures. This unexpected slowdown sent ripples of concern through the market. Could this be a sign of a weakening economy? The Federal Reserve keeps a close eye on employment data. It plays a crucial role in their interest rate decisions. A weak jobs report could give the Fed pause. Will they be less likely to raise interest rates now? The uncertainty lingers. Despite the mixed signals from the economic data, investor sentiment remains cautiously optimistic. The potential for tariff relief is like a beacon of hope, overshadowing the concerns about the jobs report. Market psychology is a powerful force. When investors are optimistic, they're more likely to buy stocks. This increased demand drives up prices, creating a self-fulfilling prophecy of market growth. However, this optimism is fragile. The market thrives on certainty. Until concrete tariff relief measures are announced, a degree of uncertainty will persist. Investors are holding their breath, waiting for the other shoe to drop. In these uncertain times, investors are seeking safe havens. Certain sectors like technology, automotive, and industrials are looking particularly attractive. The tech sector, known for its innovation and growth potential, continues to be a favorite. Companies like Apple and Tesla are seen as industry leaders driving market sentiment. The automotive industry stands to benefit significantly from tariff relief, particularly if it focuses on USMCA-compliant imports from Canada and Mexico. Lower tariffs could translate into increased sales and higher profits. Industrials, often seen as a barometer of economic health, are also attracting attention. Tariff relief could boost manufacturing activity, leading to increased demand for industrial goods. A picture is worth 1,000 words, especially in the world of finance. Charts and graphs can help us visualize market trends and understand the impact of various factors. The recent market surge is evident in the upward trajectory of the Dow Jones and S&P 500 charts. These visual representations clearly show the positive reaction to the potential for tariff relief. By analyzing these charts and data points, investors can gain valuable insights into market movements and make informed investment decisions. The market, like life, is unpredictable. It ebbs and flows, often in ways that are difficult to foresee. This inherent unpredictability is what makes investing both exciting and challenging. Investors must be prepared for the unexpected and stay agile in their strategies. While the recent surge is encouraging, investors should remain vigilant and informed. It's easy to get swept up in the optimism of a rising market, but it's crucial to remember that what goes up can also come down. Staying informed means not just following the headlines, but understanding the underlying factors driving market movements. Several factors could impact the market in the coming weeks and months. These include economic indicators, corporate earnings reports, and broader geopolitical events. Each of these elements can create ripples that affect market sentiment and investor confidence. Keep a close eye on trade negotiations. Trade policies and agreements between major economies can have significant implications for global markets. The outcomes of these negotiations can either bolster investor confidence or lead to increased volatility. Will the tariff relief materialize, or will it be another false dawn? The resolution or escalation of trade tensions can impact everything from commodity prices to the stock valuations of multinational corporations. Investors should be prepared for either scenario. The outcome of these talks will significantly impact market sentiment. Positive developments could lead to a surge in market activity, while negative news could trigger a sell-off. It's a delicate balance that requires constant monitoring. The Federal Reserve's next move on interest rates is another crucial factor. Interest rates influence borrowing costs, consumer spending, and business investment. The Fed's decisions can either stimulate economic growth or cool down an overheating economy. Will they prioritize economic growth or inflation concerns? This decision will be closely watched by investors, as it will provide clues about the future direction of monetary policy. A focus on growth could mean lower interest rates, while a focus on inflation could lead to rate hikes. Their decision will have ripple effects throughout the market. Changes in interest rates can affect everything from mortgage rates to the cost of capital for businesses. Investors need to be prepared for the potential impacts on their portfolios. Lastly, global events, from geopolitical tensions to economic indicators, can impact the market in unpredictable ways. Events such as elections, natural disasters, and international conflicts can create uncertainty and volatility. Investors must stay informed about global developments and be ready to adjust their strategies accordingly. Staying informed is key to navigating these turbulent waters. By keeping a close watch on these factors and remaining adaptable, investors can better position themselves to take advantage of opportunities and mitigate risks. In the ever-changing landscape of the financial markets, knowledge and vigilance are your best allies. The stock market is a dynamic and ever-changing landscape. The recent surge in the Dow Jones and S&P 500, fueled by hopes of tariff relief, highlights the market's sensitivity to geopolitical and economic factors. While the potential for easing trade tensions is a positive sign, investors should remain cautious and informed. The jobs report serves as a reminder that challenges remain. By carefully analyzing market trends, understanding economic indicators, and staying abreast of global events, investors can position themselves to seize opportunities and navigate the volatility of the market. Remember, knowledge is power, especially in the world of finance.